Why life insurance is generally not worth it for you, especially if you're under 65. So, I've crunched a lot of numbers, and I think that life insurance is generally way more expensive than what it's actually worth to you, and it's better just to invest that money into the S&P and compound it over time. That way you have a good sum of money at retirement and you can spend that how you will. Most insurance companies will offer you a policy and let you select your coverage options. Then they just give you a premium, but they don't tell you exactly how much that policy is really worth to you and what exactly you're paying for and what you're really getting out of it. Insurance companies typically won't give you this information because they don't really have an incentive to do that. So it's really hard to know what you're actually paying for. So to kind of break open this black box, first we'll go over valuing the insurance policy. Number two, we'll go over why generally it's not worth it to you based on the data. And then number three, a few exceptions, because I think every rule has some exceptions. Now, I've created a spreadsheet for you where you can input your age, your gender, and your insurance premium amount, where we can figure out exactly how much the insurance policy is worth. I want to specify here that I'm talking about term life insurance, which means you have a policy for, let's say, 20 years. You pay a premium each month or each year, and then you basically are covered for something like $500,000, and that policy expires at the end of the term. On the other hand, you have something called whole life insurance, and whole life insurance, you basically pay into the policy for your entire life, and when you pass away, you get a payout from that policy. However, this policy is generally very expensive, and I'm not going to cover it today because there's plenty of videos out there. Bringing it back to term life insurance, let's say you are looking at a 20-year policy that pays out $500,000 in the event that you pass away. And let's say you are age 25 when it starts and your premium amount is $250 a month, which basically pencils to $5,000 over the duration of the policy. The most simple way to calculate this is using an expected payout formula or an intrinsic value of the policy to us. That formula, very simple, is the policy payout, which is $500,000, multiplied by the probability of using the policy, or pretty much the probability of dying during the period. We know the policy payout of $500,000, but we don't know the probability of passing away. There's obviously no way to know this for sure. However, we can look at a study from the Department of Social Security. They analyzed 100,000 individuals and found the probability of passing away by age and by gender. You can see these numbers here, and they're actually pretty low for the most part at the younger ages, and we can see any snapshot in time. So at age 25, we can see the probability of passing away. And the next thing we need to figure out is what is the chance of passing away during that 20-year period. So from 25 all the way up to 45. So we can do a little bit of stats 101 and figure out our probability of passing away during that 20-year duration. That number from 25 to 44 for a male is 0.44%, or about 4 in 1,000. We can use that number to figure out our intrinsic value. So we're just going to plug in 0.44% into our formula there. Our intrinsic value is $2,200. Whereas our cost of the policy is $5,000. The cost of the policy is $2,800 more than our intrinsic value. From looking at that alone, it looks like that we are way overpaying for our policy, which could be true from some perspective. However, we need to consider that this expected payout formula is also the expected loss for the insurance company. So they need to charge you more than that expected value in order to make a profit and cover some of their other expenses. So pretty much any policy that you're going to look at in insurance is going to be more than your intrinsic value. Now you might say $2,800 over 20 years, that's not really a big deal, right? It's correct that that sum of money is not a large amount. However, we need to consider the opportunity cost of not using that money to invest in the market, because everything we invest in the market will compound significantly over time. We also need to keep in mind that once our insurance policy expires, the value of that policy is effectively useless. Let's say instead of investing our money into the insurance policy that's going to expire, we instead invest that $5,000 over 20 years into the S&P and get a 10% return. In that event, we'll actually have just about $16,000 from that investment at age 45. Now, you might say, well, it's only $16,000 at 45. The $500,000 seems a lot more valuable to me. Two things to keep in mind here. Number one, remember that the chance of using that policy is 4 out of 1,000. So we have a 996 out of 1,000 chance of that policy expiring on us and effectively being worthless. Number two, and actually more importantly, that money is $16,000 at 45, but we're likely going to keep compounding that money over 20 years because we want to save it for retirement and when we're even older and when we actually might pay that out to heirs or our spouse. You can see here the value of that money over time: 45, 65, 70, 75, and 80. And at age 80, that money is worth $442,000. So a lot more than our initial investment of $5,000, and that is almost the amount of the payout of that insurance policy that we bought at 25. Well, you might say again, $442,000 at age 80, still not $500,000, and I have a chance of passing away before that. What's the big deal? We need to keep in mind that this is only the money from the first life insurance policy, so it's only your policy from 25 to 44, and when you're 45, your coverage expires, so you need a new life insurance policy. The thing with the second policy though is by the time you're 45, you're going to be paying multiple times what you paid at 25. The data I found suggested that at age 50, your average premium would be $800 a year versus that original $250. Let's assume at 45, we'll pay $750 to keep the math clean. Let's get the intrinsic value of our policy once again. So we'll do the same math. We will take our $500,000 payout, and then we'll plug in the probability of passing away from ages 45 to 65, and that's just about 2%. So the intrinsic value of our policy is around $9,900. We'll just say it's $10,000 for simplicity. And we can see we're overpaying for this policy by about $5,000. Again, maybe not a huge sum of money. However, we need to run our opportunity cost formula one more time to figure out what is the true cost of it. This time, instead of investing $5,000, we're investing $15,000. If we compound that over 20 years, 25 years, 30, and then 35 years, it's still gonna be pretty significant. And as a matter of fact, it's gonna be worth about $200,000 at age 80. If we look at policy 1 and policy 2 together, we have about $440,000 plus $200,000, which is about $640,000 at age 80 by not purchasing life insurance. So that $640,000 is definitely more than the $500,000. We don't have to worry about the policy expiring. So my personal opinion is that I don't think life insurance is worth it. And if you are going to get it, I would probably say wait until you're like 45 because you just have such a low chance of passing away below that number. And I think you're just going to end up forfeiting a lot of future wealth down the road. However, I do want to say this is just math and there might be some exceptions where life insurance is actually worth it for you. Number one, interestingly enough, when you're above 65, you have a pretty significant chance of passing away. So if you don't have a lot of savings at 65 and you can afford to purchase a policy, maybe it is a good idea to buy it. Although an insurance company is going to be pretty reluctant to actually give you one at this age, in my opinion. Number two, if you're the sole income earner for your family and you have some young children with you, I think it might be a better idea to be a little bit more cautious if you don't have a lot of savings built up. If you do, I think it's better just to let that savings compound and you should have plenty of money to pass down in the event of passing away. And then number three, if you just want to be extra cautious, this entire analysis of insurance is really based on your risk tolerance. So if you have a higher risk tolerance like I do, you're probably more comfortable without insurance. Whereas if you have a lower risk tolerance and you just want to be on the safe side, go ahead and get it. It's not a major expense. You're really only giving up future wealth down the line. Remember, you can download the sheet in the description, which will let you input your age, gender, and insurance premium amount. If y'all have any thoughts down below, or you disagree, or there's something else you think everyone should look at, definitely comment down below. Going to be uploading some similar videos like this on investing, personal finance, economics. This is my first video, so looking forward to creating a lot more, and I hope you all have a great rest of your day.